So, which one is better for you, REITs or DST? So both of them represent attractive opportunity for real estate investment. REITs are particularly appealing to investors with long-term investment horizon, those seeking to avoid the complexity of a frequent 1031 exchanges. Those design greater investment diversification, individual interest in higher quality options compared to DSTs, and those looking to invest in retirement funds. On the other hand, DSTs attract investors who are specifically looking for replacement properties to fulfill a 1031 exchange, and cash investors interested in particular DST properties or that aims to gain experience with DSTs before making larger investment in the future. A real estate investment trust REIT is a company primarily involved in owning and managing real estate assets. Established in 1960, the REIT structure offers investors the chance to invest in a diverse portfolio of large-scale income-producing properties, aiming to provide ongoing income and appreciation. Collectively, REITs own approximately $4.5 trillion in gross assets in the United States. Calculate taxes from REIT distribution or individual or dividend can be intricate, as these distributions might consist of three types of income which are taxed differently. First is ordinary income, mostly derived from property rents, taxed as ordinary income in the prevailing federal and state tax rates. Second is the qualified REIT dividends. So depending on the time frame of the income generation, a portion may be eligible for a lower tax rate, often referred to as a capital gain distribution. Another one is return of capital. Some dividends may be a return of original invested capital and are not taxed, typically occurring when depreciation deduction exceeds the REIT's profit. Additionally, the REIT investors do not directly own real estate, but rather shares of stock in the company that owns the real estate. So income received is reported on the tax form as interest and dividends, and investors usually receive a 1099 DIV. Summarize dividend at the end of the tax year. Let's talk about qualified business tax deduction. So the Tax Cuts and Jobs Act of 2017 introduced the qualified business income deduction, allowing investors to reduce taxable income from REITs by up to 20%. Unfortunately, the deduction is set to expire in 2025. Taxation of capital gains when REIT interests are sold. So when REIT interests are sold, proceeds are subject to capital gain taxes, potentially reaching up to 20% plus applicable state taxes. Unlike 1031 exchanges available to other real estate investors, REIT investors cannot reinvest proceeds via a 1031 exchange. On the other hand, a Delaware Statutory Trust or DST is a separate legal entity created in 2004 to hold title to one or more income-producing properties. So similar to REITs, a DST might hold title to multiple properties simultaneously, though generally fewer than in a typical REIT. Each investor in the DST owns beneficial interest, qualify as an acceptable replacement property option for a 1031 exchange. So basically, if you own an interest of a DST, you can actually exchange it out to another 1031 exchange. Taxation of income from DSTs. So ongoing income from DST are treated similarly to traditional real estate investment. So at the end of tax year, DST investor receive a grantor's letter, potentially containing a 1099 or income and expense statement. So this information is used to complete a Schedule E to calculate taxable income. Schedule E deductions allow investors to significantly reduce taxable income, potentially putting more money in their pocket compared to non-real estate investments. Taxation of capital gains when DST interests are sold. So upon the sale of DST interests, investor might face combined federal and state liability of up to 40%. However, investors have the option to defer up to 100% of their tax by completing another 1031 exchange. In contrast to the sale of a REIT interest, where capital gains tax reduce reinvestment funds, proceeds from the sale of DST interest can be fully reinvested in like-kind property via 1031 exchange. In summary, both REITs and DSTs have unique advantages, catering to different investor profiles and objectives. So, which one would make the most sense for you right now? Leave it in the Q&A section of this course or a comment in this video. So let's move on to the next topic.